Good. We are live 8 minutes late. Really, actually, about 2 hours or so late from our 12:30 every Friday, Real Fridays with Brock Cassidy, Rick Rock, and Jeremy Potter. And but no, but I apologize for being a few minutes late, Jeremy. I was running from a meeting. I'm at my cabin in Vermont, and so the snow. There's like 2 feet of snow up here, and it's incredible how beautiful it is, but it just took me a little bit longer to get back situated here.
Sure. Understood.
I actually just got off the phone with a God, my hair is a mess. It's one thing about wearing a hat in the winter, But yeah. I actually just got off the phone with Justin Kaplan he's an executive over at Atlantic Bay. Just a really, really phenomenal guy. He's been with the company, I think he said 13, 14 years. And Atlantic Bay is one of those companies that's been kind of a mainstay in the southeastern part of the United States. It's a phenomenal company, very strong in the Virginia beach markets. And we were just mind sharing about, the marketplace and what everyone is seeing in the marketplace. And it's just fascinating, man. I'm telling you, like this industry has been so, I want to say rattled, but I don't think anybody really knows what to do or how to take. Is Sky going to join us? Oh, Sky's doing a breaking news with
breaking your chain of thought. What's going on, Doctor?
That too.
I like surprising Rick when I can. It's not often.
Well, I heard the little bleep, and I thought it was Brock, but I'm much happier to see Sky. This is perfect.
I won't tell him you said that.
Yeah. But no, what I was saying was, Justin. So Atlantic Bay is like a $5 billion lender or so. They're smaller than NFM, but they're a serious player in the Southeast. And Justin has just been a really sober, very smart, very patient, steady growth kind of leader for that organization, 100% retail. And he was saying that, like, and I agree, we both agree that the market's been sort of, I don't want to say paralyzed, but there's a paralyzed quality to it because we're in such dynamic state of flux that there are those that are going to sort of change their organizations on the front end of that flux and probably maybe just sort of catapult themselves ahead of the curve when the dust starts to settle. And then there's going to be probably the bulk of the companies that are going to wait to kind of see like what happens with the CFPB, what happens with the FHFA, and what happens with HUD, if they even exist, for God's sakes, to any, comparison that they exist today. Talking about a confusing time to run a mortgage lender on any kind of national scale. It's pretty fascinating.
Yeah, I mean, there's really only 2 things that mortgage companies are thinking about this year, maybe every year, right? Sales and regulatory risk. We've eliminated everything else. Like, we've eliminated everything else that an independent mortgage company does. They do sales and they control for loan delivery risk, regulatory risk. That's it. So yeah, it would be paralyzing if the 2 things that you can control, the sales and marketing and the volume that's attainable in your area, whatever that footprint is, and the regulatory are frozen or to use your word, paralyzed. Yeah, that would be tough to make a decision because those are my only 2 levers. And right now, a lot of homeowners are equally uncertain with what's going to happen with their household balance sheet. And so they're not doing anything. And, Fannie and Freddie might be getting a lot smaller. Rate sheet might be changing. Footprint might be changing. So it doesn't surprise me to hear how would I operate in an environment where the only 2 things I can control are out of control. And I think, one of the things that comes to mind for me is we don't have any products for this. Like, we don't have investors for this, and we don't have products that meet this need. And that's why we're frozen. We're stuck with a HELOC and a 30-year fixed, and that's it. And so when Fannie and Freddie don't buy them or they don't apply to the front end of the market, what else we got? You know, and HELOCs have tipped up a bit. We talked to Figure last week. You know, some banks and some lenders are coming in. Sky can talk to us a little bit about non-QM lenders that are stepping in, but not in a way that we would think actually addresses this moment in time. And I can see why. By the time you address it, it could all change, to your point. But I think that it tells a bigger story than just, oh, the White House is creating chaos with, you know, fast decision making and sort of the way they've foreshadowed cuts at these agencies.
Yeah.
But I think it's also a failure of having anything else to be able to do in the primary market other than what, you know, the existing regulatory the existing regulatory and investor world will allow us to.
Yeah. So do you think this will be do you think this is the open door to kind of to finally sort of develop a non-QM market?
I don't know. If not now, then never, I guess. Like, it has to be now. Yeah. This is the best opportunity for that I've seen since I've been in the biz.
Yeah, I think we certainly see our non-QM investors looking to grow their business this year and being aggressive about that on pricing and, you know, on rate sheets, and similarly, like IMBs that didn't have a non-QM business are now getting into non-QM as a diversification, right? Because it's now you don't know what's going to happen with Fannie and Freddie, right? And so you got to have something else in case stuff goes sideways, right? So I think that diversification into other products is starting. I mean, at least anecdotally, we've seen that with a few partners. So you know, it's probably overall good for the industry, right, to have more options. But you know, I think we're all sort of waiting on the Fannie and Freddie thing to some extent. I forget, Jeremy, if it was you or someone else we were talking about. It's like, you know, if they privatize, what would stop Fannie or Freddie from becoming a direct lender themselves, right? And cutting out the sales you're talking about, you know, from the IMBs. I mean, there's weird worlds that could occur, right? And if that happens, you better have a non-QM channel.
They'd have to rewrite. I was going to say they'd have to rewrite the charter, but yeah. I like your mentioning of it because I think that a lot of people have been way too comfortable with, oh, this will never happen, or that'll never happen, or this could never happen, or that could never happen. And I've been hearing that less and less, but I heard about it a lot over the last 6 months. And now I think we're in a position where most people aren't going to say that anymore. Anything could happen. Is it unlikely that Fannie and Freddie rewrite their charters? Sure. But nothing's impossible today. And that, yeah. So,
well, what's interesting is kind of to that vein or to that effect, you know, Figure launched their platform, their white label platform, to actually sell direct to investors to bypass sort of the GSEs as well. So it is kind of interesting where there's a potential play where there's just that whole middle market of the industry could potentially get squeezed out, where it could very well go from consumer to investor in one delivery model by usage of technology, where brokers, independent mortgage banks, credit, they're all just completely eradicated. The correspondent investors, they're all just completely eradicated from that origination mix. And it's just a point of sale and then investor delivery secured and guaranteed by way of blockchain or some kind of securitization, instrument. But we are living in such an potentially accelerated dynamic time that I think we'll see where it actually ends up, you know?
Yeah, I think what you're talking about is a really, really slow attrition.
Yeah.
Not necessarily a lightning bolt moment for the industry. Like, I think Fannie and Freddie, I guess I'll put it this way. I think they'll be around forever in some shape or form because this is such a fragmented market still that companies will still be selling production in. And to the point Sky made earlier, that like they may look a lot different than they look now. They may be an eighth of the size they are now in terms of headcount or delivery capability. But I think the securitization platform is such that even if it went that way, it would still be around forever because some production would still be going there in all these little pockets around the country. But what drives the market is technology and scale. And investors are going to find it if it's there. And to your point, if there is a way to buy and sell mortgages with almost instant verification and validation of the underlying credit risk, then, what are you really holding out for? The implicit government guarantee? When you have the data to know, wasn't that always the issue? Is like origination quality was the problem. Like, once we have origination quality instantaneously, then a lot could happen in the investor side of the exchange. I don't know. So I just don't think it moves fast.
Don't you think that this is the moment? It seems like there's so much moving fast right now. An argument could be made that if there is a time where something's going to move fast, it's going to be now.
Yeah, fast in the context of mortgage, but yes.
Yeah. What I know it's so funny. I know we've been trying to connect for probably a month, Sky. So I apologize I've apologized publicly now, I should say, for being so.
I'm glad you're still standing.
So,
or maybe
yeah,
you're sitting, but yeah.
No, trust me. It was a weird couple of weeks, but I'm definitely.
Did you see the press release?
I did on SunWest. I absolutely did. I love it. I saw that. In fact, I think I saw that this morning. So that finally sort of came into fruition, and I love it. I mean, look, I think we spoke about it. I think I did a post from the Housing Wire conference back last fall from Dallas, and I did an interview on the crib equity product, and I think it's an absolutely perfect product. And I'm telling you, equity share came up yesterday. I was in a meeting. Where was I? I was in a meeting with a lender out in Las Vegas, out in the West Coast last week, and they brought it up to me saying that this equity share kind of product is becoming more and more. It's coming up more and more in the conversation, particularly around consumers that don't have enough for a down payment. And so the focus of the conversation was sort of the low to middle income FHA kind of consumer that doesn't have the down payment, and how home equity agreements are becoming much more part of that conversation. And obviously it was kind of like a light bulb moment for them to kind of say, like, guys, like all this stuff we've been talking about with crib equity is exactly like, do you guys get it now? Like, this is what we've been talking about for the last month. And now all of a sudden it's sort of come full circle.
Yeah, we're, it's interesting, right? I mean, I think some people have they don't even quite know why, but there's some sort of allergic reaction to home equity or equity sharing programs because of past iterations of the product, right? So it's like, oh yeah, I know that thing used to exist, and I don't think it's good, right? And so I think the challenge we're facing sometimes is just to get in front of those people and have that conversation, so they can understand the ways our product works that are more advantageous to the transaction, to the home buyer. So we just did that yesterday with a big broker network, and 5 to 10 billion size, and that was how they showed up to the meeting, was like, well, we've seen equity share and it doesn't really work for home buyers, right? And so then we leave understanding that it can. And the interesting thing is, like, I actually just before hopping on was running some scenarios for a buyer, and it's not always the low down payment. It's not always the affordable piece. It's also the accessible and the flexibility to have sustainable home ownership, and people who actually are managing the finances of their home purchase. So we were running numbers for a buyer, about $1 million home purchase or so. They're putting down 15% themselves, and they wanted another 15% down from us. That's a big slug, but it was going to change their mortgage payment by about $20,000 a year, right? And so now they're looking at, hey, if I'm in this house for 5 years, I've just guaranteed myself $100,000 return, right? And so now all of a sudden that home's got to appreciate, above, averages 4-5% a year before it, that doesn't make sense for them. And that's not even considering the time cost of money or what they could do with investing and the returns on that money they get every year. So, they're just looking at it and saying, like, hey, my cash flows is way, way better. And why wouldn't you want, your mortgage payment to start with a 5 instead of, high 6s or 7s, right? And that's a big deal for some people. So, I think those scenarios definitely play out, and it's not just a I can't afford to get into the market, but it's, afford to do it on the terms you want. So there's a ton of flexibility there.
I think you laid it out perfectly. Because the thing that I've been thinking about with this, when we talk about adoption and that kind of understanding, or how Rick started off the question with, like, some people have this initial reaction to it. I think of it the same way as like PMI, for instance, right? Like, you go back 30 years and the whole thing was avoid PMI, put 20% down, because that's what the guy who owns the house giving you the advice was able to do. And so you march through time, and all of a sudden it's like, oh, I'm not going to put 20% down because I could do more with my money elsewhere. So I'll put 5% down and I'll get a Freddie Mac or Fannie Mae home ready, home possible loan or whatever. And like, I'll pay PMI because I'd rather have some cash in my pocket, blah, blah, blah. So what I'm saying is the stages happen in these like 20, 25 year cycles. So what was true when we did consumer sentiment 20 years ago, and all these guys got their jobs in our industry, they were like, no, this is what you do. And then now we're saying, like, yeah, but you got to understand, like, what can we show you? What can we show you in the research? What can we show you in the numbers? What can we show you in the industry to tell you that today's home buyer wants more flexibility and options than that? It doesn't mean they're all going to choose it, but
yeah, totally. And I mean, it does impact affordability too, because I mean, this buyer could go either direction. They could do 15 down themselves and still manage the purchase. But if you couldn't, the qualifying income goes from like 170, 180 to like 130, right? Because of that payment change too. So it does change the threshold at where someone can join in. So, and speaking of joining in, Brock, I'm glad you're here. I don't know what it looks like. I'm glad you're here for multiple reasons, but like, I felt like the 3 across screen that we had was just a really, like, a nice close up, and so I appreciate it.
Yeah, I'm just here to get it
hand out a little bit. I got a little more space.
Oh, here we go.
This is
space
perfect.
to operate. Yeah. This is how Rick sees the world, by the way.
Yeah, you've heard of hiding the self view. Rick enhances the self view, enlarges the self view. Wow, prime time. I like what I'm hearing, Sky. Yeah, is that one of the big use cases that you guys hear out of the gate? Is people that basically could get the loan anyway, but are putting the money to work elsewhere.
Yeah, definitely. I mean, there's
their net worth in a home, basically.
Yeah, there's three real scenarios. So one is clearly the affordability piece, right? So it's like qualifying for the purchase price that you want, and that could be getting in the market or just getting more in the market, because you can take your purchase price up if you got more money to put down.
Sure.
The second is that flexibility. So cash flow. Hey, I got my down payment, but I want to, get a lower LTV mortgage. I want to improve my rate. I want to improve my cash flow. I want something that's easier to carry and more sustainable. And then the third is actually liquidity, right? So like, people they want to hold on to more of the cash. So maybe they were going to put 20% down themselves or something, but they rather that someone else contribute and they keep that cash, right? Either they're a, business owner or entrepreneur, or they're, want to have other investments. That money is currently invested somewhere, whether it's like, brokerage or 401k or something. You don't want to pull it out because there's tax consequences, and maybe it's just a good investment for you. So we see people that just want to sit on that money, also for themselves, like more emergency funds, more reserves, ability to, to do capital improvements to the home itself. So there's a lot of reasons why people want to hold on cash after purchase. So that kind of comes up as well.
Yeah, NewZip's in the process of launching a new partner that brought something up I hadn't really thought of before that is somewhat related, where they're catering to investors, primarily overseas investors, and they're bringing people in with sort of like a really large pre-approval, and they're not sure whether they want to buy 3 rental properties or one expensive, $1 million place, or 300, 400K places. And so they want to talk about the real estate process with NewZip. And it's like, oh, that's a super interesting, like something I think of as super atypical, because we're mostly dealing with primary home buyers. But, it's like you start thinking about all the different, I guess, options, right? It is kind of the conversation I walked in on, you can get creative when you have different options, right? You can, this is only for primary homes, right? At this point. Yeah.
Yeah. We're doing primary homes,
but it could be to do the primary home and also buy a rental property, right? Like with the same amount of money. Like
We've seen that actually. So someone actually already owns their home, right? But then, and they need equity from that home. They need the value of that home to go buy
Sure.
home, right? But they bought that home before the pandemic they refinanced. They've got a super low rate. It's appreciated to a level where, they could cash flow it if they could rent it, right?
Yeah, sure.
So they want to use our product to then buy the next home so they can keep the first one also as they move up. So we've seen that buyer come across as well. I mean, there's a ton of flexibility. Cool. You can also, if you got more investment too, you can or more capital at your disposal at purchase. Like, we've had questions about, hey, can I buy down the rate? And you definitely can, right? So there's a whole bunch of different ways that can work.
Cool. Yeah, happy to hear that.
So do you think that we're going to see, you must be feeling that the market is beginning to thaw. The ice is starting to thaw in its approach toward these equity sharing kind of relationships between an investor and a consumer. I feel it, but I wonder, because you're more on the front lines than I am specific to this product. Do you feel that there's a kind of a thawing or of the understanding or increased comfort level with the product?
I think there is. I still think it's very early days though, right? So, it's not permafrost, but it's not all the way thawed yet, right? There's still a lot of education to be done, and a lot of and that exists for consumers, but also for loan officers, for real estate agents, and part of it is there's also there's not a clear taxonomy yet. There's not definitions around how this product works the same way there is with a loan product, and so we need to mature as a market and as a segment of the market to be able to give that sense of certainty to people about how it works and what the terms are. Because we actually, we have to spend a reasonable amount of time going through that with each counterparty, right? So that they understand it, because it's not there. And we've taken painstaking efforts to have very clean and clear, plain language disclosures. We want to be at the forefront of ensuring that there's transparency into how all these programs work, because we think it does work. But it is definitely improving, and programs like California's Dream for All have gone a long way towards improving that too. There is a recognition in certain markets that these kind of programs do exist, and there are a large number of applicants that are looking for programs like that. So it's coming, right? And I think it's in some sense it's an inevitability that it will serve some part of the market, because it does provide a flexibility and improved affordability. But we're far from a traditional home purchase, I would say, just yet.
Yeah, I think. Go ahead, Rick.
No, I don't think it'll ever be a part of a. It won't. I don't think it's going to remain a niche kind of product. I don't think it's going to be a mainstream kind of solution. But I do think that But this market is so vast and so large that you don't have to have a very large piece of that pie. You can have a very small piece of the pie and still be very, very, very successful as an organization or even as a product. But what were you going to say, Jeremy?
I was just going to slightly disagree, because I actually think that it'll become one of the main ways you can afford to buy a house. And I know I'm early on this, so it'll probably be longer than I think it will be, to your point, Rick, about the share. But I think eventually one of two things has to give. Either this way of thinking about financing a home becomes a major option for first-time homebuyers, or incomes have to dramatically increase relative to new jobs and just absolute bull market. Because otherwise, I don't understand how home prices can keep appreciating, and they will, because the upper half of the market's doing just fine. And so if we're going to turn over homes to new home buyers, and the home prices are going to stay strong relative to the demographics and the upper half of the market, the only way to get new home buyers in is going to be products like this or extending term. And I don't think we're going to do a 40-year mortgage, and I don't think we should. So I think we're doing this. I think it's going to become as ubiquitous as down payment assistance.
Yeah, I think what's that quote? It's like the tendency to overestimate short-term change but underestimate long-term change. I think that's how I would see it too. I mean, it won't happen overnight. It has to become some level of standardization. But I do agree that there's probably, given the current market, I think there's probably even a third of the market that should be looking at this product as an option, just from a purely financial perspective.
Jeremy, but you sit more on the side of the fence of shared equity agreements between consumers, right? I mean, if I wanted to give you money to buy a house, but I didn't want to live in it, but you wanted to live in it, but you didn't have the down payment for it, but I just wanted to be on the title but not live in it and not be a co-borrower, that's an easier transaction than it is. I can see that. I mean, because that's in essence what's the platform that Spencer Rascroft put together?
You mean like Picasso for single,
Yeah.
Picasso for primary residence?
Yeah, so that becomes kind of a shared equity kind of agreement between consumers, which seems to be a lot easier to digest than it is a company or an investor sort of investing into it.
But are you saying that because of the return, or are you saying that because of the logistics? Because it's a much more complicated relationship to do it with you and me than it is with a business that does it all day, every day in 50 different markets. But we do know that if you can put your money to work, you want a return. That's people do. So I think if you're saying like, will institutional fixed income investors be skeptical of return profiles? I'll get into that conversation all day long because I'm not sure and I want to know and I want to figure that out. But if you're saying you think it's actually more straightforward for two people to work together, I would totally disagree, because people screw up relationships all the time over stuff like this, money and house.
People are doing it directly, and it's usually a parent and a child.
Well, yeah, it's
and that's like 40% of young home buyers, right?
I just met two friends or.
I bought a house with my friend when I was 22 in Detroit. Yeah. We both lived there, and a third friend lived in the third room as a renter. I worked at a mortgage company that helped.
Dude, I think a lot of people do that.
Yeah.
I'm for it. I'm for it. I just don't think it's easy. Yeah. I think it's complicated.
I think you said two things though, Jeremy. Is that from a scalability standpoint, I agree with you. Having an investor or an organization to enable thousands of transactions or tens of thousands of transactions is a lot easier. And use of you have a single source of funds and you have a technology to enable it with many consumers who are of need. I think where you get the Jeremy Rick scenario where we're going in on it, there might be some level of complexity, but not really. I mean, because there's a single point of contact. Like there's a single point of failure, either on my side as the investor or your side as the consumer that's paying the bill every month. And if there's an issue or a default or some matter of arbitration or some matter of litigation, it's pretty clear. We know who Rick Rock is, we know who Jeremy is, and we're going to court, right? Yeah. It becomes a bit more less clear, with an organization. Now, having said that, I mean that becomes that's our relationship with most consumers with a servicer, anyways, because the servicer becomes that single point of contact, which is an organization, kind of a faceless organization, if you will. But I do see this was in today's Wall Street Journal, which kind of gets to your point, Jeremy, today around I'm just going to share my screen. Basically where, the market is really trending, and this isn't news to any of us per se, but with so much, I don't want to say the concentration of wealth, but the concentration of buying power is being increased in the top 10% of earners. All of a sudden, this kind of supports the opportunity for a shared equity agreement to kind of say, like, until this problem's fixed here, where more earners, where more of the broader pie is expanding its purchasing power, you get these shared equity agreements to kind of enable home ownership in a way that a good portion of Americans can't do it today.
Yeah, I haven't seen somebody control for it quite this way in terms of like buying power relative to home ownership. But this is exactly what I'm saying. The upper half of the market, in this case, the upper 10% of the market, is doing so well that it skews the outcomes for everybody else. And I also think it skews a lot of the numbers. I think a lot of the national numbers we hear about are actually just the top half of the MSAs, or in this case, the top half of individuals transacting in the market, overshadow how hard it is in all the other ones, in all the other markets, in all the other brackets. And this is why I think home prices will remain strong and continue to rise, 3 to 5%, maybe even in a lot of markets, 5 to 10%, no matter what. But this is a real problem for generational wealth and getting new homeowners into the market, which is how everybody has thought about their business over the last 12 years.
To your point, the generational wealth will continue to happen, but just with a narrower set of consumers, because that'll still, my kids will be fine. Your kids will be fine. Sky's children will be fine. Brock's children will be fine, right? Because we'll have the liquidity to be able to pass down through, buying a condo or buying that starter home. The problem is there's such a large, vast segment of the American population that doesn't fit into that top 10%. And the problem is only going to get worse with a lot of the immigration trends. There's going to have to be more assistance to support these families by way of education and just upward mobility from an average wage standpoint. Because this problem is only going to get worse and worse because the more low to mid income consumers, i.e. citizens, i.e. residents, there are in this country. The problem is only going to get exacerbated.
Yeah, I think, Rick, you know a little bit of my story, but so much of our families, finances have been impacted for the positive by entering into homeownership, right? So it's this piece where people who can benefit the most from that wealth creation of homeownership, or they're going to keep losing out to people that already have it, right? So that's where we moved 1,000 miles to buy a house that was less expensive, right? Yeah, and actually start that clock and get into the game, and it worked out, well for us. I think it can work out well for a lot of people, but not everyone is willing or able to do that, right? To uproot, to go somewhere else. They don't have a job they can take with them. They don't have those kind of things, right? So it is. It's actually a really depressing graph. I haven't seen that one before.
I'll send it to you. But Sky, when you said I know a little bit about your personal circumstance, I thought you were talking about your shared equity agreement that you grew up in the commune. You grew up in San Francisco, in your little biodome, commune. Because that's the.
I did grow up in a dome, in a geodesic dome, though. That my dad actually built, right? So I was born in that house. So but maybe not surprising with a name like Sky that I would be a home birth in a geodesic home, but it wasn't a commune. It was a single family home.
I've been calling it a commune for the last year that I've known you, and I'm going to stick to my story. My story is way better about your upbringing.
Whatever gets clicks for you.
At the end of the day, Rick will do anything for the clicks.
Oh, yeah, right. Including this show. Yeah. Clearly, this is me stepping to the bottom of the barrel to get clicks. But no, this is good, man. Look, we're in such a wild market right now, as far as uncertainty, that I don't see it clearing up anytime soon. We had a really strong start for January. February was very soft, and I think a lot of consumers, and I think the national numbers support that as far as originations and real estate sales. But it'll be interesting to see how we spring into the spring, or turn the corner into the spring.
Were you guys all out at the Housing Wire economic event? I'm curious what the takeaways were from that, just in terms of where the
water was, right?
Yeah, I think the takeaway from what Rick just said that applied, I thought, most directly to addressable market was, so 56 million homes are owned free and clear. That means of the 38 trillion in home equity, if you round up, the 38 trillion in home equity, over 20 trillion is owned free and clear. The other approximately 17, 18 trillion is attached to a mortgage. That portfolio of mortgages is so if you think of the country as a portfolio of mortgages, it's the lowest LTV ever. it's under 46% LTV as just across the country. So like the amount of home equity is bonkers. And then what's going to happen, how that gets transferred, because if all cash buyers were 28-30% of the market historically, it's going to be over 40% this year. And it'll be off of that home equity.
Or just the bottom 10% of that graph, Rick showed.
Yeah, right. Yeah, exactly. So that's, I mean, I think that is the story, which is even when you control for a $2 trillion market, which let's say Fannie Mae or MBA is saying 1.8 trillion or whatever, it's not even really accurate because the addressable piece is only 60% of that. When you start to look at cash and equity, and when first-time home buyers do win a house because they're later in life, they have more wealth, they're buying it at a lower LTV, and they don't give up a house to get it. So when we had a traditional move up or downsize buyer, they're giving up a house. So a transaction was a chain reaction. But in this case, if a first-time home buyer is lucky enough to get in the market, they're not freeing up a house. They're just taking one off the market. So I think it does represent constraint, a lot of constraint. There still will be deals done. There still will be mortgages. And as we know, life events will always be more compelling than interest rates. When you want to get married, when you want to have kids, when you want to move, you talk yourself into it. It's kind of the behavioral economics of it. But it's tough. It's tough to get in the game with some of those numbers. Barry Habib said, demographics is destiny. And I just thought that was a quick shorthand way of saying what I'm always saying. Like, yeah. And so I'm just going to take it and give him credit for it. But like, that was his slide. Demographics is destiny. Like it's, you know, there are a certain number of houses. There's a certain number of baby boomers that own those houses. Gen Z and Gen X and millennials are trying to get in the game. And they either are or are not yet. And it's math at that point.
Demographics is destiny. That's curious. That's interesting.
Yeah. So that was a couple of the takeaways I saw. I mean, if you want the classic question, what rate's going to do this year, which everybody had to address because it's an economic summit, the general consensus was it'll go steady or down, but it won't go down more dramatically than mid-6, a 6 handle. And so Silk Title gave out T-shirts. We did a little ad at lunch for low 5s. The only advocate for low 5s I saw all day was Silk Title. So if that happens, you heard it here in February, on the last day of February. But from stage, the general consensus was mid-6s.
Yeah. I mean, Barry a few months ago was saying mid-5s. So this isn't. So he's changed his tune, quite a bit. But I would say if we're at 6.8 now. Right, 6.83 or so right now. So it's like if we end up at, there's a big difference between 6.5 to 7 to 6 to 6.5 as far as freeing up the amount of transactional volume or activity based on that. So if we go south of 6.5, then things are going to get pretty interesting. But if we hover around 6.5,
we're not far off. I mean, it's been dropping day by day this week. I think I saw 6.6 ish today. So that's getting in that range for you, Rick.
The headline, the aggregators are going to clip that and say that Brock was advocating for a 6.66 interest rate. So if anybody's watching this and wants to put that out on their blog, you'll definitely get clicks.
Yes, that is my my personal view and not the view of the officials at Real Fridays nor NewsZip.
Our editor in the control room is going to be yelling in our ear about that. Yeah.
Well, good to. Well, I think this is a wrap for Real Fridays. Appreciate you guys. I know that I'm in Vermont with my daughter Gigi, and I'm gonna work a few more hours, and then we're gonna hit the snow. So
skiing.
Yeah, or do something. Yeah, or snowshoeing or something like that.
Lovely.
Great. Thanks for joining us, Sky. I'm
Yeah,
really
pleasure.
glad you
Scott,
jumped
you
on.
were a guest of honor, man. I loved it.
Thank you.
I'll wear my tag proud today.
Have a good weekend, guys.
Take care, guys.
Bye.